If I had a red flag, I would wave it now. I mean a red warning flag. Welcome everybody to Chapter 20, Corporation Tax, Groups of Companies. This is part one of two parts. What I mean by red flag is students don't like this chapter. They don't like dealing with groups. Give them a single company for corporation tax. In other words, a company that is basically just trading on its own, and ask them to do a corporation tax computation, the list that we saw, and apply a rate. Yeah, they're sort of okay with that. But when it involves two or three different companies, either in a loss group, the first area that we look at here, or as in part two, a capital gains group, they do not like it. And the key point really is not just that students don't like it, is that the examiner knows this, so he examines it. This is an important chapter for us. Let's take a look at the first area. Let's talk firstly about taxable entities. Now, we know what a corporation is, and we certainly know about residency, we'll recall that. Now, in terms of the impact of those two areas on this area of groups, where we have a company or companies within a group of companies, they become in effect a special case for CT purposes. Now, each company still has its own corporation tax computation, but what we're saying is in these two scenarios, first one here in part one, loss groups, second one, capital gains groups, in these two scenarios, really we're talking about an area of CT that is standalone, and indeed we're talking about the advantages that each company can gain from being in one of these groups, or perhaps both of them, okay? But that doesn't affect their own individual CT comps as such. It just allows them some advantages. So what do we mean if we open that up? Well, first things first, let's talk about losses, So where we have what we would call a loss group, losses can be relieved on a group-wide basis, So we could have a company that really has a standalone CT comp, but because they're a member of this loss group, they could be in a position where they could claim a loss from another company and therefore reduce their corporation tax. That's the first type of group that we'll explore in this video. The second type of group is this area of a chargeable gains group. Now, what does this mean? Well, this means that if you're a member as a company of that group, chargeable gains may be reduced, and indeed capital loss relief made easier, okay? So in essence, this whole area of groups under the corporation tax banner centers around the idea of these two different types of groups and the advantages for individual companies, separate companies, of being a member of these groups, okay? So there's the setup, okay? Now, outside of that, let's deal with the first type of group. Now, this is called a loss group or group relief group, if you will, or 75% group. Any of the above would be fine. So in this particular type of group, the definition is as follows, okay? We're talking about a parent company, and its 75% subsidiaries, okay? Now, these companies may be resident or indeed non-resident, i.e. resident overseas. Now, what is a 75% subsidiary? Let's be clear on this. A 75% subsidiary is one in which the parent company owns directly 75% or indirectly at least 75% of the ordinary share capital, and, note, is entitled to at least 75% of the distributable profits and assets of that company on a winding up. So there's two sides to the definition of a 75% sub. Now, we'll move into or explain this indirectly in one moment, but imagine a scenario, we've got three companies, A, B, and C. A owns, let's say, 100% of B, and B owns 80% of C, then that is, in effect, a holding up of the 75%, because A and B are certainly in a group, and indeed A indirectly holds more than 75%, in effect 100% times 80 of company C. So that's what indirectly means. The second part of the definition, not overly important, but if we get a written question to define, include this bit, okay? So this is what a loss group or a 75% group is. This is what it represents, okay? Now, outside of the definition, what are the principles, okay? Now, as mentioned on the right-hand side there, basically this idea of group relief is the relief of all or part of the losses of the surrendering company against the profits of one or more claimant companies, note, for the corresponding accounting period. One more time, a lot of information here. I'm saying that we have formed a group. For argument's sake, there's three companies, ABC, yeah? We're saying that, let's say, company A has losses and company B and C have significant profits. What we have is corresponding accounting periods. Now, this is important. They all have a year end of 31st of December. All of them. This is important because you're going to see down below, the examiner is going to target this. So given that scenario, okay, great. We've got company A with losses. Company A can surrender losses to the claimant companies B and C if it has enough. And indeed, we know that everything's in play, i.e. a group has been formed and there's corresponding accounting period. So there's the upside, if you will, or indeed the advantages of these companies being in a group. What does it mean at the end of the day? Well, think about it. If they weren't in a group, what options would they have for loss relief? Company A is an example. Well, maybe it just has to carry forward, But now, given the group status, it can actually utilize the loss earlier, because of that connection with B and C. Okay? So, outside of that, in terms of loss relief and group relief, consider this, We now have, as we know, a two-tier corporation tax system. Now, what we mean by that, let's be clear, is as of FA 23, we know that the CT, or corporation tax rates, have changed. No longer is it 19%, We now have a main or higher rate of 25%. We also have that marginal relief area that we saw, okay? So that's why they call it two-tier, i.e. one tier 19%, second tier 25%. That's a change we know from FA 23. Okay, so now, given that, the most important factor in this area for a 75% group or a loss group is generally the rate. I mean, think about it. If we have a company within the group that's actually paying at the main rate, 25%, and we have another company that has losses, great idea to share those losses with that company because it's going to save at 25%. Now, so the rate is key. If we form a group, we may have more than three, maybe 5 or 6. We may have one company with massive losses and all the other companies paying CT at 25%. This is a nice little angle. Now, outside of that, what else is important? Well, obviously, timing is important and indeed cash flow in relation to the relief claimed. So, generally speaking, we'd like to claim relief earlier than later. So rather than, let's say, a surrendering company, let's say in our case, our scenario, company A, rather than it carrying it forward against future total profits before QCDs, why doesn't it surrender it now to its colleagues, i.e. to other group companies? That's a cash flow advantage. That's a timing advantage, okay? So moving from there, in terms of planning, given what I've just said in the previous branch, broadly speaking, within this 75% group, what are the objectives? What are the objectives? Well, it's simple enough, common sense. What we need to do is to minimize the group's corporation tax charge. Note that I say the group, i.e. I'm talking about in aggregate. Yeah, let's minimize the charge. And indeed, outside of that, where we have the option to use losses rather than carry them forward into the future, let's use them now. Okay, so that's the objectives. What is your examination approach? Now, there's a lot of information here. I don't expect you to be able to understand all of this right now, but I'll work through it, yeah, and just give you a feel for how you might approach. A word of advice: don't be put off just because we've come into a tricky area of the syllabus and you now see a set of steps that you may think that you have to learn off to be able to score reasonable marks. Not really. What we need to do is just understand what's on screen. And as I've said many, many times, you're probably sick of listening to me, let's just apply this process nice and easy to questions. It's not as bad as what you might think. So, in terms of dealing with a 75% group question, first things first is let's establish the group. Who's in the group? Because maybe not everybody is. Remember when we talked about formation and definition? We could have 6 companies, perhaps only 4 of them satisfy the definition, where there's not either direct or indirect 75% holding. Okay? So first and foremost, I want to know who's in the group. Okay? Second step for you is what losses are available? Is there a trading loss or perhaps other losses? Yeah? What losses are available? Outside of that, generally speaking, work from the early to the later. Work chronologically, whatever you do, okay? Outside of that, I would say this next sentence, which says, give priority to the relief that can only be relieved in a specific way, capital losses, i.e. going to be carried forward, generally. Yeah, deal with the easy bits first, okay? Deal with the easy bits first, okay? Capital losses, more often than not, are easier to deal with than other losses, okay? Now, where a loss can be relieved in several ways, identify the feasible options. So, for example, it might be that a current year claim is good for the company, or it might be perhaps group relief, yeah? And indeed, if it is group relief, determine the maximum limit for each claimant company. More of that in a moment, okay? Outside of that, in terms of our point about objectives and indeed the rate up top, remember we said let's save tax at the highest possible rate. If the relief can be restricted, certainly claim at the marginal rate, and this roughly speaking is 26.5%, but not always. It depends upon the augmented profits, okay? Now, in terms of applying logic here, yeah, if the marginal rate 26.5, we know that the main rate is 25%, yeah, we need to be sort of putting the company in a position, let's say, where we relieve losses in such a way where perhaps we can push profits down to the lower limit, okay? Now, why do I say that? Well, let's think about it. The lower limit, or indeed, the small companies rate, 50,000, yeah, would attract 19%. So in essence, what we're saying here is you can manipulate the situation to be able to push a company that is paying tax at the marginal rate without loss relief down into the small company's rate, okay? So in essence, what we're saying here is, okay, there's a step-by-step approach, very long-winded, maybe a little bit confusing. But in essence, if we establish the group, identify the losses, work from the earliest to the latest, and then look at the different ways that each loss could be relieved, dealing with the easier ones first. Broadly speaking, that's what it says here. Okay? Now, in terms of this area of corresponding periods, this branch, non-coterminous accounting periods, is important because you remember when we said up top, in terms of the definitions and indeed the loss, surrender and claim, we talked about corresponding periods. Yeah. Now this word coterminous or non-coterminous means we could have a situation where they're not corresponding. In other words, the accounting year ends are not corresponding. Group relief, as we saw up top, is given for corresponding accounting periods. You know, the period that is common for both surrendering and claimant companies. So, simple example, we've got A and B in a group. They have year ends of 31st of December, both of them. One's going to surrender, one's going to claim. We're good, okay? Different scenario, yeah? We have two companies, A and B. One has a year end, company A, of 31st of December. One has a year end of 30th of September. In terms of corresponding, it's only 9 months now. It's the first 9 months of the year, okay? So we need to be careful. And indeed, this area here, when I started off by talking about red flags, is certainly an area that confuses students. So let's see how this manifests itself. And in other words, how we get to a point where, let's say that we have two companies, yeah, and we don't have corresponding periods. In other words, we have non-coterminous periods. Yeah, the example that I gave was 30th September and 31st of December. Okay. Now, in this particular case, yeah, in the case that I've just described, the loss relief available to be surrender claim is capped or restricted. The maximum loss for group relief purposes will be the loss of the surrendering company, the corresponding accounting period over the accounting period of the surrendering company. In other words, this fraction, yeah? So in the case and the scenario that I gave, yeah, we're looking at, let's say, company A, 31st of December, 2024, company B, 30th of September, 2024. Let's say company A is the surrendering company and indeed the loss-making company. Then in effect, we'd be talking about the loss, let's call it, 1 million times 9 over 12, okay? So we can only take the loss for the corresponding period. Now, conversely, in terms of maximum profits, yeah, same thing. So in our scenario, I used B as the company that was doing the claiming and had the profits. The maximum profits that can be surrendered is available profits in total, corresponding period over accounting period. So in effect, again, 9/12 of the profits. Now, in essence, the maximum amount of group relief is restricted to the smaller of the two above amounts. Yeah. So what we're saying is, in questions where a 75% group is relevant, and you're trying to establish, okay, well, I know that we're going to have to surrender and claim, but how much? Well, this is how you work it out. Question is, what is the corresponding accounting period? My example with A and B is simple. Yeah, two companies, one 31st of December, one 30th September. The corresponding period just dropped out, didn't it? It was easy enough. It's only the first 9 months, 1st of January through to 31st of December, no, 30th of September. It's only 9 months. That's it. Okay. So watch for this, and again, it'll open up once you see it in action. Now, similar to the above, yeah, companies joining and leaving the group. Okay. Now, a corresponding accounting period starts when a company becomes a 75% subsidiary. Prior to it becoming a subsidiary, so for example, with a parent company, it's got, say, 5 subsidiaries. It then buys a company, buys 100% of company XYZ. That company XYZ, has now become a subsidiary. So the corresponding period now starts. It didn't start before because the company wasn't a member of the group. Its shares hadn't been purchased. Outside of that, a corresponding accounting period ends when a company leaves the group. And you'll be thinking, well, how does a company leave the group? Does it walk away? No, it gets sold. So imagine that company XYZ that I mentioned, in 5 years' time, the parent decides to sell the company. In effect, on the day of sale, it ceases to become or ceases to be even a part of that group. Okay? So here, in summary then, time apportionment as with the above, would be relevant, wouldn't it? Yeah, because this all centers around the idea of corresponding accounting periods. Yeah, so some fractions to be had. Yeah, so that concludes the theory side. Now, again, I do think with corporation tax groups, loss groups, and indeed in part 2 we'll deal with capital gains groups, I do think even more than anywhere else, practice is key, because the concepts are a little bit tricky, non-coterminous year ends, surrendering and claiming, etc., etc., etc. A little bit tricky, okay? So practice is key. I hope that at least this part 1 has given you a feel for the area and that you'll follow my advice. Remember, it's just like riding a bike. The more we do it, the better we get at it. Okay? Thanks for listening.